welcome everyone to the second of our quarterly tax legislative updates. Today that we're looking to cover is Adam Sweet is going to talk with us about some of the most recent developments with respect to the PPP loan program, the forgiveness aspect of that in particular. Joe Stoddard is going to cover issues regarding the employee retention credit, and also in particular the proposed expansion of this credit that is currently pending in, or has passed now, the House of Representatives, and presumably is pending with respect to any future legislation. And then finally, I will wrap up with a summary of really the likelihood of additional COVID-19 legislation this year, as well as the outlook for some of the specific provisions therein. So with that, I'm going to turn things over to Adam, who is going to lead us through the current events with respect to PPP. Adam?
Thank you, Mel. So as Mel mentioned, Adam Sweet, I'm a principal with Eide Bailly. I sit in Spokane, but my focus is really pass-throughs, and my focus more particularly this last 4 months have been the Paycheck Protection Program. So thought we'd spend maybe 15, 20 minutes today giving an update on where things stand with the PPP. So just by brief background, how did the PPP come about? It was part of the CARES Act, which was really Congress's second response to the COVID-19 pandemic. The basic framework is it's money that's loaned through the SBA's so-called 7A loan program. For most borrowers, for all borrowers, what this means is you go to your local lender, you borrow money. That loan is guaranteed by the government, so the lender has no risk. And then the borrower, if you do certain things and use the money in certain ways, then the loan can be partially or fully forgiven. So it's almost, in a way, think of it as a grant program, in fact. And the whole focus is trying to encourage borrowers, encourage employers to maintain payroll during the COVID-19 pandemic, keep people off unemployment. And I always think of it this way. This is the way I talked about it 3 months ago, and it's still really the way I think about it now. Is there's two stages to it. There's a loan stage, which was on the front end when you calculated how much you could borrow. And then there's a forgiveness stage, which is adding up your eligible expenditures, going through the application process, trying to get your loan forgiven. Almost all borrowers at this point are probably in the forgiveness stage. Even though the program is still open to new borrowers, I think new borrower activity is certainly lagged behind where it was a few months ago. So for most of our clients, certainly they're in the forgiveness stage, no longer in the loan stage. Just real quickly, I still get questions from time to time on this, even this late in the process, about COVID, about eligibility for the PPP program, the questions typically take the form of this, that I'm a borrower, I'm operational during the COVID-19 pandemic. Operational meaning I'm still open for business. Whatever I do, I'm still generating some revenue. I may not be up to full capacity, but does that mean somehow that I'm not eligible for the PPP loan? And why that question came up is, I'll give you just a brief timeline here in these slides. Originally, when people incurred their PPP loan, borrowed their PPP loan, these were the certifications that they need to make. That basically you needed it due to the uncertainty of COVID-19. Notice what is not there is you didn't have to certify that you didn't have money from another source, that you somehow had any kind of liquidity shortfall, and therefore you needed the loan. So consequently, a lot of people consider themselves eligible for the PPP loan. That was certainly our best advice to clients who asked us about it, as it seemed pretty broad-based. Most states were in some form of a shutdown. Businesses' doors were closed. Pretty uncertain times. The market was crashing back in April, so sure seemed like it wouldn't be that difficult for most businesses to meet these certifications. But like everything with the government, it starts out pure, and then that there was perceived abuses highlighted by the media, and the perceived abuses were large companies that made use of the PPP loans. And then there was pushback saying, well, these large companies have access to other sources of capital. Let's say they're publicly traded. Let's say that they have access to a large credit line from a national bank, and therefore they shouldn't be eligible for the PPP loan. So there's a whole series of FAQs that the SBA pushed out FAQs, frequently asked questions, where the SBA seemed to indicate that as part of the original certification to get the PPP loan, you had to take into account your access to other forms of liquidity. Wasn't anything further provided in that. It introduced a ton of uncertainty for small borrowers, our clients. You know, if the guidance was targeted really at large businesses, they didn't refine it to only go after those who they might have perceived as abusing the process. So we had lots of clients, even with loans of a couple $100,000, that were calling us saying, am I going to go to jail if I keep the loan? Ultimately, what the SBA said was this, that if you borrowed less than $2 million, you won't be audited. If you borrowed more than $2 million, the SBA will audit your loan before it is forgiven. We don't know what form that audit will take, but if you borrowed under $2 million, there is no automatic audit. You still could be looked at by the SBA, but the chances are much lower. So I think for most of our clients, the end result was they can feel good about where they stand now, about the certifications they made back in April or May, whenever they borrowed, and maybe be less worried with what the SBA was getting at with those FAQs. And frankly, you know, my view of it is there's a lot of unneeded uncertainty introduced by the government with those FAQs, and hopefully we're back to where we were before, where most borrowers can feel good about their original certification and their eligibility for the PPP loan. So the other big updates that we've had, this is now, you know, 3-4 weeks ago, but the PPP was materially changed by Congress in June 5th, 2020. It was changed by Congress and passed by the president and enacted into law on June 5th in 2020. And what were the big changes? Well, the biggest change was it modified the covered period from 8 weeks to 24 weeks. Covered period is the time period over which you have to pay or incur eligible expenditures. You sum total up your eligible expenditures, and that gives you a tentative forgiveness amount. There are a lot of borrowers that were saying, hey, 8 weeks is not enough. This pandemic shut down maybe months on end, and I need more time to pay or incur expenditures. Congress gave that to people, saying you now have 24 weeks. For loans that were in issue before June 5th, that were issued before June 5th, 2020, the borrower can choose to apply the 8-week covered period if they wanted to. A lot of people say, why would you want to do that? Why wouldn't you want 3 times the amount of time, 24 weeks versus 8 weeks, to incur eligible expenses? In our experience, it's been borrowers for the most part who are planning on that original 8-week covered period and have incurred enough expenses and just want to be done with the process. So they elect to apply the 8-week covered period. They're going to apply for forgiveness now with the bank and be done with it. We do also have updated forgiveness applications from the government reflecting this 24-week period. So if your bank tells you that they're still waiting on something from the government in terms of a forgiveness application, I won't say that's not true, but certainly banks should be going forward right now. Lenders should be going forward right now processing forgiveness applications, because we have updated forms and updated instructions from the government reflecting this 24-week covered period. I'll move. We have a short amount of time here, so I'll leave these slides here for people to look through. But the basic gist of it here is that using the 24-week covered period, it really may end up being that most people qualify for total forgiveness, because the loan itself is based on 2.5 months of payroll. And now you have almost 6 months to incur eligible expenses. And so even if you maintain payroll at even partially what it was last year, you're probably going to incur and pay enough expenses to achieve full forgiveness. Who does this help? It helps new and recent borrowers who weren't planning on under the 8-week program. You know, maybe who's not helped is anyone who was planning on the 8-week covered period and maybe had incurred some extra payroll expenses, had paid bonuses and so forth. Those types of people are less helped by the 24-week covered period because they've already spent most likely most of their PPP loan, assuming the 8-week covered period. Open questions. These questions have actually were answered last week. You can apply early. So if you apply the 24-week covered period, you can apply early. So you could apply in week 15, for instance. And it appears in week 15 that you would test at that time. You would tally your eligible expenditures, and then you would also calculate your FTE or full-time equivalency, as well as your per employee salary. Why are those two things important? Those two things are important because they can reduce your forgiveness amount, but you measure those all, it appears, on the date that you apply for forgiveness, that you don't have to wait until the end of the 24-week covered period. This makes sense. If you forced everyone to wait until the end of the 24-week covered period, you'd have a whole rush of people applying for forgiveness in November and December. It makes a lot more sense administratively that as soon as you have enough expenses, you could apply at that time, and that you can calculate at that time whether you're eligible for full forgiveness or not. The other big change from the new legislation was originally the CARES Act gave you a bucket of expenses that are eligible expenditures to give rise to forgiveness. The SBA interpreted that to mean that 75% of your eligible expenditures have to go to payroll. That is now 60%. So this is Congress explicitly stated, no, you don't have to spend any more than 60% of payroll. 40% can go to overhead. Also not a cliff rule, meaning if you only spend 50% on payroll, you still get some forgiveness. You just ratchet it back by that amount. So this goes back to my earlier point of probably a lot of borrowers will be in a much better forgiveness space with this new legislation. Before, you could only go 25% to overhead. Now 40% of your qualified expenditures could go to overhead. There's some new exceptions for the FTE rules, and we'll move through these quickly. So FTE, again, is full-time equivalency. That's supposed to be 40 hours per week per person. If you cut your FTE count, then you can ratchet back your forgiveness. So let's just say if your FTEs count is only 90% of what it was during a pre-COVID-19 period, then there's a 10% cut to your forgiveness amount. So there's some existing exceptions. If you would cut your like everything Congress does, right? There's a rule, there's an exception, then there's an exception to the exception. So the rule is you add up your eligible expenditures, you get forgiveness. The exception is if you didn't maintain your FTE counts, you could lose some of that forgiveness. And the exception to the exception is what we're covering here, where even if you cut your FTE count, if you fall under certain exceptions or safe harbors, you may not lose forgiveness. So the first existing exception is that if a borrower refuses to come back to work, this has happened to our clients from time to time. This could be either because an employee, so a borrower makes an offer to an employee to come back to work. The employee says, I don't want to come back to work, maybe because of the additional unemployment insurance, I'm better off at home. Maybe the employee is worried about COVID-19, very understandable. But whatever the case, if they refuse to come back to work, that doesn't count against you. The one nuance here is that the application now states that you have to tell the state unemployment insurance office within 30 days of the employee rejecting your offer to come back to work. So there's an assertive act. Not only do you need to offer the job back, but you actually have to assertively notify the state unemployment insurance office that the employee rejected the offer in order to satisfy this exception. The other couple of exceptions, if you fired anyone for cause or if anyone resigned during the covered period. Also, if you restored your FTE counts during the covered period, that also is an exception. And then this brings us to our new exemption. So the current exceptions all apply, and then we have two new ones. One of them talks about basically if you can document that you've been affected by these shutdown orders by having to comply with state and federal mandates in regard to COVID-19, if that somehow restricted your business and therefore you weren't able to operate it at full-time capacity, that can accept you. There's a little question here about how shut down do you need to be from this. There's an example in the final interim rules where someone was only partially shut down and could still rely upon that exception. But still another helpful exception to the exception there, where if you've had some FTE cuts, it may not result in your forgiveness being reduced. Also, now your deferment, so PPP forgiveness wouldn't be as beneficial if somehow you were forced to pay interest or make principal payments during your covered period. Forgiveness would matter less. So what they said now, what Congress said a couple of weeks ago was, if you get full forgiveness, the full amount of principal and interest that accrued during that period is all forgiven up until the date of when your loan is forgiven. So it should be, if you get 100% forgiveness, it should be that you don't owe any money back to the lender, you don't owe any money back to the SBA. For those borrowers that are not able to achieve full forgiveness, the original rule, and in fact for most borrowers, if they look at their note with their lender, there's a 2-year maturity date on that note. The new legislation extends that maturity to 5 years for new loans, but it also says that existing loans that have that 2-year maturity date and the note, you can go back and renegotiate with your lender, and at the lender's discretion, you can extend that to 5 years. So this may be something for existing borrowers, probably 90% of the people out there that already have loans reflecting this 2-year note. If you have a loan on the books that won't be totally forgiven, you may consider approaching your lender to modify that note from 2 years to 5 years, but you need the lender's permission to do it. There's nothing automatic about that. Payroll tax deferral, this was again updated last week by the IRS, but originally what the IRS was saying, the IRS's interpretation of the CARES Act is that you could defer your payroll taxes, the employer share payroll taxes, up until your PPP loan is forgiven. At the point that the loan is forgiven, you can no longer defer the employer share payroll taxes. And maybe just by way of brief background, the employer deferral for payroll taxes was introduced as CARES Act as another mechanism to generate cash flow for taxpayers. Think of it as an interest-free loan, because whatever you defer in 2020, you pay back in 2021 and 2022. But now with this new statute, PPP borrowers are placed in the same shoes as everyone else, that they can fully defer the employer's share of payroll taxes even after the PPP loan is forgiven.
Adam, this is Mel.
Yeah.
One of your slides mentioned some question as to whether the June 30 date had been moved to December 31 as a result of the legislation. What does that specifically refer to? Is that the time for making an application, or is that a different piece?
So good question. So originally, the original statute that came from Congress used June 30th for a couple of reasons. One, the program ended on June 30th. The PPP program ended on June 30th. Two, it was also the date where if you would cut FTE counts or if you would cut salary, if you restored those cuts by June 30th, then you weren't subject to any forgiveness reduction. So now it appears June 30th is stricken from the statute. There's now a date of 12/30. And one, the PPP program ends now on 12/30. Two, it appears that as well that if you're trying to restore FTE counts or restore salary, it's now your measurement date is 12/30 rather than June 30th. But to my point about being able to apply early, you don't have to wait if you've had cuts to FTE or cuts to salary. We don't think you have to wait until 12/30 to restore those. That if you've restored those in week 15, and let's just say that's middle of July, we think that at that point you can apply for forgiveness and achieve full forgiveness if you've restored those. Because what the SBA has said in their forms is that it's the earlier of, if you've restored FTE or salary, the earlier of December 30th or your application date. It's a little fuzzy still, but that's our current interpretation.
Very good. Thank you for that.
A couple other things here. I know I'm running short on time, but I want to just cover a couple other very common questions we get and continue to get from clients. One, if you look at the forgiveness application and the accompanying instructions, it says that when you tally your eligible expenditures during the covered period, you can include both payroll costs paid and payroll costs incurred. So it appears this is a very borrower-friendly rule, that it's both a cash basis test as well as an accrual test. And to kind of illustrate that point, we get this question quite a bit. Let's just say you borrowed on April 29th, or let's say your loan was funded on April 29th, and then you had a payroll expenditure on April 30th. But the payroll expenditure relates to the previous 2 weeks. So technically the payroll costs were incurred before the loan was funded. Technically it's paid on April 30th. Your loan was funded on April 29th. April 30th is during your covered period, and that's paid. So our interpretation is that full payroll cost counts towards an eligible expenditure. So you could see here how you might end up with if you use the 8-week covered period, you might end up with technically more payroll costs counting as eligible expenditures, and really you had payroll periods during the 8-week period. Some of the pressure is really taken off this now, though, with the 24-week covered period. There's less pressure there because we have so much more time now to incur eligible expenditures. So there's still a question that comes up, really more towards people using the 8-week covered period. Our response is it appears to be both a cash basis and an accrual basis test. This goes to my point here in FTEs. It looks like now, as Mel mentioned, June 30th is stricken. It's now December 30th, but our interpretation now is you don't have to wait until December 30th to restore your FTE counts. It's measured upon the date that you apply for forgiveness. Also, what has not been solved yet, we need another act of Congress to make PPP expenditures tax deductible. The IRS, in its infinite wisdom, decided that PPP eligible expenditures are not deductible. The IRS said, well, because the loan forgiveness isn't taxable income, therefore the expenditure should not be tax deductible. They said, we don't want to give a double benefit to taxpayers. I think some people have questioned that analysis because it seemed like Congress intended for a tax benefit to be gained by a borrower with the PPP loan, but that's where it stands now. So we need an act of Congress. Hopefully this summer, if we have another round of coronavirus legislation, hopefully Congress will let us know, and the president will sign into law to let us know that we can deduct those expenditures. Also, just keep on the lookout. There's been a lot of new guidance that has come out, even last week, end of last week. We continue to get new FAQs, new interim rules that help us flesh out this new program. So just pay attention there. And then these last two slides are just the documentation that you're going to need to start preparing when you get ready to submit your forgiveness application. Pretty voluminous what you're going to have to give to your lender. And some of it is even stuff that you need to keep in your records for 6 years. So I guess just in closing, you should be talking to your advisor. Hopefully it's Eide Bailly, but whoever it is, talking to your advisor now and talking to your lender now about the forgiveness stage of the PPP loan process and what it's going to take to submit your forgiveness application and what it's going to take to get your PPP loan forgiven. And for simple applications, there may not be a lot of work. We're certainly seeing for larger borrowers that have had cuts to FTEs or cuts to salary, it's a lot more complicated maybe than what people first appreciate. And I think with that, I will turn it over to Joe.
Fantastic. Thanks, Adam. All right. We're going to talk about an update to the employee retention credit. So the employee retention credit was first passed as part of the CARES Act. One thing to note before we dive in too far is that there's a provision in the CARES Act that only employers that are not receiving a PPP loan are eligible for the ERC. So to start there. But if for those employers that were either too large or had access to capital or some other reason didn't take advantage of the PPP loans or decided to return their funds, their PPP funds by that May 18th deadline, they can now consider eligibility for the ERC. So before we talk about the proposed enhancements to the ERC, we'll do a quick overview of the current law. So this is a refundable payroll credit that's computed based on 50% of qualified wages. We'll talk about that in a second. The way that the math works, the maximum credit per employee is $5,000. This is a payroll credit, so technically the first part of the credit offsets the employer portion of Social Security tax, but the rest is refunded. So you don't have to you have to show the credit offsetting tax liability to take advantage. After you decide whether you've taken a PPP loan, the next step is to determine if you're an eligible employer. And there's really two ways to qualify. One of them is a kind of a black and white test. That would be, have you had a significant reduction in gross receipts? And that's defined in the current law as a reduction of at least 50% in any calendar quarter in 2020 compared to the same calendar quarter in 2019. If the answer is yes, then you're an eligible employer and you can move to the next step. The other way to qualify is more of a subjective test, and that's if you've had either a full or partial suspension of operations due to a government order related to COVID-19, you can also qualify even if you don't meet the gross receipts test. Another important note is that most tax-exempt entities can qualify for the ERC. However, that does not include governmental employers or their instrumentalities. A few other important notes around the existing law. It does require aggregation. So if you have commonly controlled entities or businesses, they do need to be combined. That can work in your favor because of one entity or one company or one employer has a partial suspension of operations, then the entire group would be considered an eligible employer. However, it can also, I guess, work against you, and it really comes to these next couple of bullet points here, because there's a distinction between larger employers and smaller employers with this credit. And larger employers that are defined under the current law as having more than 100 employees. You can only claim the ERC if wages are being paid, but employees are not providing services. However, for smaller employers, you're allowed to claim the credit for all wages that are being paid. So less than 100 employees, all wages are being paid, whether or not the employees are providing services. This for larger employers that are over 100 employees, this is not an all or nothing test. You can certainly allocate time and a portion of wages being paid. So if you have an employee that's able to provide services half the time, but they're receiving 100% of their salary or their wages, you can claim the ERC on the other half of their wages where they're not providing services. But again, you have to look at the employee count based on the aggregation rules in the first bullet point. Another important point is that qualified wages do include health plan expenses. So many of our clients that have furloughed their employees, even if they're not paying those employee wages, if they continue to pay benefits, those employer health plan expenses are still considered wages. So you can claim the ERC on those types of expenses. One more overview before we get to the proposed changes. Just how to claim the credit. There's several ways to do this. Now that we're here at the end of June, you were allowed to reduce your federal tax deposit by the amount of the anticipated credit. So it's a way to get your cash sooner rather than later. There's also, you could submit an application, a Form 7200, which is a new form to receive advance payment of the credit. Or a lot of companies who weren't desperate for cash have elected to take the credit on their quarterly 941 filing. So again, now that we're at the end of Q2 and folks are starting to prepare for their Q2 payroll filing, now a lot of our clients at least are going into the details of computing this credit. So any credit that you earned at the end of Q1 and then any credit that was earned during Q2 can be claimed. If you haven't already taken advantage of this, it'll be claimed on the 941. Even if you have, say, reduced your federal tax deposit, that'll all be trued up and reconciled on the 941 that's due here in another month or so. So what are the proposed changes? So as Mel mentioned in the introductory part of this, the House passed the HEROES Act in the middle of May, and a big part of the act was these proposed enhancements to the ERC. And these are some fairly major changes, and we have some examples to kind of illustrate this. But the first thing we wanted to highlight is it increases the percentage of qualified wages. So in the current law, it's 50%. This would change that to 80%. A big deal that would really broaden the companies that can qualify for this is that the gross receipts requirement, instead of being a cliff test, so if you'd only meet the gross receipts requirement if you had a 50% reduction, now it's phased in. So if the HEROES Act were to become law, starting at a 10% reduction in any calendar quarter, you would start to be eligible. Now it would be a prorated portion of the credit, so it wouldn't be the full amount. But even companies that were not partially suspended, that had a 10% reduction in gross receipts, would at least be eligible for some ERC. So that would be huge. The limit on wages is also significantly changed. So the current limit is $10,000 per employee, and that's a cumulative limit. So in Q2, if you were eligible in Q2 and you paid $7,000 of wages, you continue to be eligible in Q3. The most you could take in Q3 would be $3,000 to get to that $10,000 limit per employee. You apply the 50% credit and you get $5,000 cumulatively on a cumulative basis. The proposed limit would be $15,000 of wages per employee per quarter. Now it does max out at $45K for the year, so a significant increase in the limit on wages being paid. We have an example on the next slide to illustrate how that would work. Again, another major change is the distinction between small and large employers is significantly changed as well with this proposed legislation. So a large employer would go from any employer over 100 employees to now 1,500 employees, and also have gross receipts in the prior year that exceeded 41.5 million. So again, this is super important because, to claim the credit for any wages being paid, regardless if the employees were providing services or not, that would change for a lot of companies that are lower than this 1,500 employee threshold. It also expands the credit to state and local governments and certain instrumentalities of even the federal government. So it would broaden this to more types of employers as well. And if this were to become law in its current form, all of these changes would apply retroactively. So just a few things to kind of highlight how this, what kind of impact this could have. So we talked earlier about the maximum per employee credit of being $5,000. If you were to max out the credit under the proposed law, that maximum credit per employee would go from $5,000 to $36,000. So again, a significant, that's 80% of the 45K maximum. So just a simple example to illustrate what kind of change, what kind of impact this could have. If you had an employer with 75 employees, that potential credit would go from $375K in the existing law to $2.7 million under the proposed changes. And then another quick example to kind of highlight the impact of the raising of the large employer threshold from 100 to 1,500. And again, the whole issue here is you could only claim the credit in the current law for wages paid for employees not providing services. So even an employer that's on the lower end of the scale. So if you had an employer with 150 employees, and let's say hypothetically that 20 employees were being paid but not providing services. So under the old law, you could max out the credit for those 20 employees at $5,000 per employee. You get to $100,000. Under the new law, you could now, again, this is on the other end of the spectrum, if you were able to max out the credit for all 150 employees and apply that $36,000 of maximum, your credit in this hypothetical would go from $100,000 maximum to potential maximum of 5.4 million of credit. So again, these changes could have a very, very significant impact on the amount of the credit. The language in the HEROES Act generally followed the exact same language that was in a separately proposed Jobs Credit Act that had bipartisan support. The one provision that did not survive into the HEROES Act was a provision that would have allowed employers that took advantage of the PPP program to also claim ERC. It would have had to have been separate wages, but you could have claimed both. That provision did not survive into the HEROES Act. So even with all of the expansion and enhancements that we outlined, you would still be prohibited from taking advantage of ERC if you took PPP, if this were to pass in its current form.
Well, thank you, Joe. And I think that's very, very important that we understand some of the ideas that are being batted about with respect to expanding the employee retention credit. This is, as Joe pointed out, a very popular idea. There is very significant bipartisan support for this, both in the House of Representatives and in the Senate. Whether or not every item that Joe went over as part of the expansion would survive is an open question. But clearly there is a real appetite on the part of a number of members of Congress to move forward with an expansion here. Of course, the issue really becomes one of is there going to be more COVID-19 legislation? If the items that Joe talked about are pending legislation, they are not in the law, and are not going to make it in unless we see a reasonable chance for this legislation to move forward. Legislation that would include this to move forward. And what we're really seeing now, I think, is a tension between two very clear economic concerns that exist. The first, as you see here, is what is this doing to the economy in terms of changes in at least the projection of real gross domestic product. And you can see here, people are beginning to talk about this as being the square root recovery. You can see the significant decline in the projection of the gross domestic product that we're experiencing right now, with a rebound, but a fairly long tail. And the Congressional Budget Office, who released these numbers within the past week, is not seeing what one might call a full recovery until we've really reached out into the 2029, 2030 area. So clearly there is a place for additional stimulus, additional relief associated with the COVID-19 situation. But on the other hand, the relief that has so far been provided has significantly contributed to where the government deficit is. You can see here, again, these are Congressional Budget Office numbers that were prepared in connection with the Department of the Treasury. Their estimate this time, or at the end of May last year, was that we would have a $739 billion cumulative deficit. Add another 1.2 trillion to that number, and you see where we are estimated now to be facing our deficit. So a tension between the need and the desire for more stimulus, the more relief to keep the economy going, with a concern that at some point the debt load does become too great and the United States begin to look something like Greece. Now, can it happen? And if it can happen, when is it going to happen? Let's take a look here at the schedule for Congress. And the magic numbers here are the ones in purple. Those are the 9 days that both the House of Representatives and the Senate are scheduled to be in session together. Now, there is some feeling that with the House having now adopted some remote meeting capabilities, that number expands. But focus now over into August, even assuming that the House takes an extra week to match up with the Senate, then there is a very, very long recess, a very long vacation scheduled for Congress. And if there's one thing that Congress does like, it is their recess. We have conflict all the time. We have partisan bickering all the time. The fact that we want to go home for recess generally is not an issue of that kind of bickering. But think now about what that date, as we go back, the date of August 7 represents. Well, back up a week from that. The 31st of July is when the current unemployment assistance runs out. The $600 per week expires on the 31st. The numbers that will be released as to July's estimate, the first July estimate of unemployment, will come out on the 7th. Now, let's think about what that might look like. And here we track the unemployment rate that is being reported over the last 20 years. And also keep in mind the 14.9% that was reported is generally understood to have been understated. So, does Congress want to be seen leaving on a month-long vacation on the day that a double-digit unemployment report is issued? And by the way, because we've left on our vacation, we haven't extended any of the unemployment relief. It seems to me that this is just politically an unlikely occurrence. And so I think there really is a great deal of expectation that we're going to see additional COVID-19 legislation being enacted right at the end of July, possibly during that first week in August. Difficult to see how it's going to happen much before then, but it does, the stars seem to line up with the idea that that would be an expected date for this to be released. Now, that then raises the question of, okay, if we're going to have legislation, what is likely to be in that legislation? There's been a lot of discussion as to whether or not additional stimulus payment checks should be made. The House went first, and in their HEROES Act, they included an additional $1,200 per person, and that is per person. That includes dependents. The dependent would be qualified for the full $1,200. There is a limit on claiming 3 dependents. So you're talking about a maximum of $6,000 check per married household, but nonetheless a fairly significant parachuting in of cost, and that of course has raised real concerns as to the effect that this would have on the deficit. Comments coming out of the administration have come from both sides, quite frankly. The recent statements by the president, some people have tried to interpret as support for an additional stimulus payment. I think that really overstates what the president said and probably what the president intended. But he did speak very highly of the idea that, yes, we're probably going to need additional legislation. Could you take that $1,200 and reduce it? Clearly, if your concern is the effect on the deficit, that may well be the solution that people look to. But that is something that we want to keep a close eye on. It would not be surprising if we see some additional stimulus payments made, hopefully with a somewhat better control over their payment than was made the last time. But keep in mind, the reason that we see $1 billion being paid to dead people checks being sent to a woman in London who had not lived in the United States for 20 years, was because the goal was to get the money out and get it out fast to keep the economy rolling. So there would be a tension if we go through this again as to whether or not you again accept a certain number of errors occurring in order to get the money there quickly versus not getting the money there as quickly in order to make sure that the money in fact does go to people who are qualified to receive it. Adam went deeply into the PPP loan program. The PPP loan program has been very politically popular. The fact that there is still some of the second round money available, although I guess that runs out, as Adam indicated, if you don't have your application in by tomorrow, does suggest that it may well be that in the absence of spending all the existing money, further extension of the period is not something that is going to be immediately taken into account. I would say that if we go farther and the employment situation does not significantly improve, we could be looking at a situation where some PPP loan recipients are still having trouble qualifying for full forgiveness, even with the December 31 date. That is something I think that Congress would respond to, but is not something that's likely to be taken up. And that is probably, if anything, a post-election lame duck piece of legislation. I guess in summary, the betting in Washington seems to be that we really have seen the bulk of the work that's going to be done with regard to the PPP loan program. And it's likely that Congress will turn to some other areas rather than a further expansion of PPP. And the area that seems to be the most likely to receive that attention is the expansion of the employee retention credit that Joe went through with you. As I said, there is strong bipartisan, bicameral support. And there is, I think, also a general feeling that there are some deficiencies, there's some changes that need to be made in the employee retention credit, and that really does open the process up to a full discussion of how broad Congress wants to make this. It may not be that we get the full extent of the expansion that Joe laid out, but this does seem to be a leading candidate for inclusion, at least in some form, of legislation that is likely to move forward. Supplementary unemployment benefits. This has been a controversial area. As we say, at the end of July, the current $600 per week supplement runs out, just in time for Congress to leave on their recess. Now, coming up, what we're told is that the $600 a week was arrived at as a national average between what the average payroll per week was and what the average unemployment benefit was. And to make people whole to, again, on a national average, then $600 was the proper number. And this was presented in open testimony during the markup process. And several members of Congress asked the appropriate government representatives, well, there are going to be some problems with this. Is there something better that you can do? And the answer was no, not really. Yes, it's create for those who were at the low end of the pay spectrum. It has created an incentive for many of them not to go back to work. They get more from the supplementary unemployment benefits than they got from actually working. But what is the solution to that? Clearly, providing geographic differences, that creates enormous political issues. We're going to pay more in New York than we're going to pay in Kansas. Nah, I don't think that's going to pass the Senate. And the idea that, well, the more you were making before, the bigger supplement you need to have when you lose your job, that again, I think raises some real political issues. There is going to be concern if there's a thought that we're coming out with double digits and that report comes out August 7, Congress is going to want to be ahead of that in some manner. the simplest solution would seem to be that the $600 a week number is reduced to what I don't think anyone has a real good sense of right now, but something that maybe is more in the $300 to $400 supplemental range is certainly something that we're hearing conversation about here in Washington. Couple of questions that I know have come in to folks here at Eide Bailly. The HEROES Act included the reversal of a number of taxpayer favorable reversals of the Tax Cut and Jobs Act from 2017. The betting is that this is not going to happen. The changes that were made in the CARES Act that provided for net operating loss carrybacks, that provided for a delay in the implementation of the business loss limitations, that provided changes with regard to the deductibility of business interest. You know, that was a heavily negotiated part of the CARES Act. It's virtually impossible to believe that the Republican Senate is going to allow that to be taken back. And also take into account the fact, you know, there was an estimate, I think, in the daily tax report today that $1 billion worth of net operating loss returns have already been filed. And unscrambling that kind of eggs is just going to be, I think, beyond what is reasonably possible. View the inclusion of these provisions in the House bill, the HEROES Act, really as a nod to the left wing of the House Democratic Caucus. They needed their votes, and they needed to give them something that they could call their own. And maybe it's part of a negotiating strategy as we move forward. In Washington, it's generally said, unless you ask for something you don't really expect you'll ever get, you know, geez, they might ask you to give up something that you really wanted. So you will see, at least in the opening round of negotiations, which is all the HEROES Act is, a number of provisions that, you know, probably have very little gas. The deduction of costs associated with the forgiven PPP debt. Again, Adam mentioned this at the end of his presentation. Enormous political support for a specific rule that would make the costs paid for with forgiven PPP debt deductible, depreciable, taken into account for however you want to cover that. And this clearly has got to be something that is done legislatively. The IRS and Treasury are not going to back off the position that they have taken. There are some kind of odd results that you get to if you were to try and do this without a specific congressional mandate. Some people in the subchapter S area have raised the possibility that that would treat the government as a shareholder, which is not allowed under the S-Corp rules. But again, very strong bipartisan support. The two chairmen, the House Chairman, who is a Ways and Means Chairman, who's a Democrat, the Senate Republican Chairman, who is a Republican, Senate Finance Committee Chairman, who is a Republican, have both strongly supported this. And I think that unless we fail to get legislation at all, this is one that has a very, very high likely of inclusion. We're about to run out of time here, so just let me mention, if you go back to the news about a month ago, there was a lot of discussion about the idea that the Democrats looking for direct aid for state and locals would need to engage in some sort of a trade with the Republican Senate. The Republican Senate looking for essentially protection from lawsuits related to the reopening of businesses. The colleges have weighed in now on this side and are definitely looking for the same kind of tort protection themselves. Again, there's a lot of discussion going on in Washington. It's sort of yesterday's news that there is a discussion, but it's very much still, and it is one that I think likelihood is that ultimately the Democrats are going to need to trade some short-term relief for state and locals for some long-term precedents with regard to protection from tort lawsuits. The details to be decided. Clearly, there are going to be strings attached to any relief that goes to the state and locals. There's going to need to be a requirement that you tie it directly into some COVID-19 related cost or some directly traceable reduction in receipts that can be, again, traced to COVID-19. On the other side, what kind of protection is there going to be? Is it going to be you meet the local standards, you meet the CDC standards? I would bet on the local standards, and I would bet that this will be limiting class actions. I don't think it does much good if you don't limit class actions. But stay tuned. Both of these ideas are still very much in play, and ultimately there's going to need to be some sort of a deal. A lot of stimulus issues have been taken to the table, particularly with regard to onshoring incentives or specific supply chain incentives. This is going to be a festival for the lobbyists. We are likely to see, I think, something probably more likely in the pharmaceutical area, but also in other areas as well. This will be a good old-fashioned political horse trading event. It is hoped that it will not derail the whole process, but at some point, those kinds of things happen. Preparing for 2021. Last thoughts here. We do have an election coming up in November. A lot of what's going to be happening, I think, including the need to go ahead and pass legislation the end of July or the beginning of August, reflects the fact that the members are preparing for an election. Depending on who wins, we could see very, very different approaches to taxation. I think that the COVID-19 has knocked some of the more aggressive Democratic proposals probably off the table for at least a couple of years. But it also does, because it relates to we're going to be seeing the economy slowed down. I think it does create some additional incentives and opportunities for business stimulus. How that is structured is going to, in large part, be determined by by where the election goes, and hopefully that's something that we can address a little bit in more detail in our next quarterly, which we hope you will be able to join us for. I would just say that you can see on the slide up there, the final slide, the email address for the three of us. And do not hesitate, if you had a question or a question later occurs to you that you've not been able to ask, please do not hesitate to get into contact with any of the three of us. Email is generally the best way to get into contact. You can always leave a message on the phone, but it tends to get scrambled when the software tries to interpret it. So if you want your question to be the one that is asked, I would urge you to consider the email and not the telephone. Adam, Joe?
Thanks, everybody.
Yeah, thank you. Yeah, just stay tuned. I mean, for like the PPP stuff, we'll have upcoming webinars, and I'm sure Joe will as well on the ERC. So also just stay tuned to iBailey emails if you're interested in any of these topics.
All right. Well, thank you all so much for attending, and thank you to our presenters. And you guys have a great day.